Let me ask you something. Have you ever noticed how the news can completely change people's emotions about money? One month, everyone feels like a genius. Investing is easy. Everything is going up. This time is different. And then suddenly, fear, red numbers, panic headlines, people saying, "Get out before it crashes." What changed? The economy didn't transform overnight, but sentiment did. And that's where we meet two powerful creatures of the financial world, the bull and the bear. Today, I want to explain what a bull market and a bear market really mean, not with complicated charts, but with a story. Imagine you open a small coffee shop. At first, business is slow, only a few customers. But then, something happens. A popular influencer visits your shop and posts about it. Suddenly, people line up outside. Your daily revenue doubles, then triples. People say, "This coffee shop is the future. It's unstoppable. You can't lose investing in this." Your shop value increases. Investors want to buy shares in your business. Even people who've never tasted your coffee want in. That feeling? That's a bull market. A bull market is a period when prices are rising consistently. Stocks go up. Investors feel confident. The economy looks strong. But more importantly, people expect prices to keep going up. Confidence feeds buying. Buying pushes prices higher. Higher prices increase confidence. It becomes a cycle. Optimism becomes contagious. Think about how a bull attacks. It thrusts its horns upward. Upward. That's the image. Prices going up, energy going up, optimism going up. A bull market feels powerful, exciting, sometimes unstoppable. Let's make it simpler. Imagine there's a new burger brand. At first, 1 branch, then 5, then 50. Every month, profits grow. People believe this burger chain will dominate the country. Investors rush to buy shares. The stock price rises from $10 to $20 to $40 to $80. Everyone feels smart. Even beginners make money. In a bull market, almost everything feels easy. But here's the danger. People forget risk. One day, something changes. Maybe ingredient costs increase. Maybe a competitor opens nearby. Maybe the economy slows. Suddenly, profits slow down. Investors panic. They sell. The stock drops from $80 to $60. Fear spreads. More selling happens. Now it drops to $40. Headlines say, "Is the burger chain finished? Was it overhyped?" Confidence disappears. This is the beginning of a bear market. A bear market is a period when prices are falling significantly, usually defined as a drop of 20% or more from recent highs. But it's more than numbers. It's psychology. Fear replaces confidence. People expect prices to keep falling, so they sell. Selling pushes prices lower. Lower prices increase fear. It becomes a downward spiral. Think about how a bear attacks. It swipes its paws downward. Downward, that's the image. Prices going down. Energy going down. Mood going down. A bear market feels heavy, uncertain, stressful. In a bull market, investors feel brave, risk feels small. Everyone talks about opportunity. In a bear market, investors feel cautious, risk feels everywhere. Everyone talks about survival. But here's something important. The market itself doesn't have emotions. People do. Markets are collections of human decisions, and humans are emotional. In bull markets, people suffer from overconfidence. They think, "I knew this would happen. I'm good at investing. This will last forever." In bear markets, people suffer from fear and regret. They think, "I should have sold earlier. I made a mistake. Maybe it will never recover." Both extremes are dangerous, because both are emotional. Imagine house prices in your city rise every year for 5 years. People say, "Buy now before it's too late." Property always goes up. Banks give easy loans. Everyone feels safe borrowing. That's a bull phase. Now imagine the economy slows. Unemployment rises. Fewer people buy homes. Prices start falling. Suddenly, those who bought at the top feel trapped. That's the bear phase. The same asset. Different sentiment. Yes, they are cycles. History shows bull markets don't last forever. Bear markets don't last forever. They alternate. Expansion, contraction, recovery, growth again. The key is understanding that both are temporary. In a bull market, smart investors stay disciplined. They don't assume prices will rise forever. In a bear market, smart investors stay patient. They don't assume prices will fall forever. Because here's the truth. Most wealth is built during bear markets. Why? Because assets are cheaper, but it requires courage. Imagine your favorite product suddenly goes on 30% discount. Normally, you'd be happy. But in the stock market, when prices drop 30%, people panic. Why? Because when prices fall, fear increases. But fundamentally, it's a discount. The challenge is psychological. Bull markets are exciting, bear markets are uncomfortable, but both are necessary. Without bull markets, there's no growth. Without bear markets, there's no reset. Like seasons, summer doesn't last forever. Winter doesn't either. The real difference between bull and bear markets isn't just price direction, it's behavior. In bull markets, people chase. In bear markets, people run. The question is, will you follow the crowd? Or will you understand the cycle? Because those who understand cycles stay calm when others panic, stay cautious when others are greedy. So next time you hear, we're in a bull market, or the bear market is here, don't just react. Ask, what is the mood of the crowd? Am I thinking logically or emotionally? Because in the end, the market is not a monster, not a hero, just a mirror, reflecting human behavior. And when you understand that, you stop fearing the bull, you stop fearing the bear, and you start thinking long-term. Finally, this channel exists for those who are ready to rise. If that's you, like the video, subscribe, and let this be your daily reminder.